still remain a hot button issue. We are familiar with free trade regulations, especially around KYC and AML. What are some of the new regulations that are challenging the post-trade environment?
So one of the biggest challenges that you have right now from an industry perspective would be some of the things like BCBS 248 on the cash and liquidity. Now that's a very interesting one because that is trying to provide the regulators with the reassurance that the banks are in control of the cash and liquidity, the way in which they behave, and it is a big challenge for banks to be able to do that on an intraday basis. To manage their cash and liquidity on an intraday basis is a very substantial challenge. Now, we've been working with a number of organizations to focus on that, but then also the challenge that you have is to make sure that you demonstrate and have control and take the opportunity to exert control over how your market behaves and how you create stress scenarios that reflect the way in which your bank operates. So for example, if you've got an organization that is very much wealth-based, they will have different set of stress behaviors to one that is very much heavily retail customer-based or one that's maybe corporate customer-based. Being able to control intraday liquidity across the DNA of your market and your organization and your customer base is a very interesting challenge. If you really sit down and speak with a lot of banks right now, for the last probably 10 years, they've been in compliance and regulatory programs.
Right.
There's been a massive shortage or paucity of innovation.
Right.
Now the banks are kind of coming out of that because they had BCBS 239, which was risk data aggregation. Then they had FRTB, which is still going on. So that's another big regulation coming down the line. So there are a lot of conflicting pressures for the same budget.
Yes.
All right. And this is one of the biggest challenges they have is how do I embrace innovation, facilitate it,
and at the same time
remain compliant.
Yes.
Exactly. But then I also have the fact that I've got the competitive world is changing, evolving actually extremely quickly. The banks were traditionally competing with other banks. Now they're competing with the digital emerging banks, non-banks. They're also competing with the fintech payment service providers. They've also got to be able to respond to the changing technology requirements. So, for example, am I doing traditional fiat currencies versus cryptos? I've got to be able to then embrace other emerging payment methodologies, so for example, using Bitcoin and blockchain. So we have a very interesting set of challenges facing the banks, some of which are regulatory, but some of which are structural.
Yeah.
All right? And fundamentally, anything that a bank does will always ultimately land on the balance sheet.
Yeah.
And as such, the banks have to be able to ensure that they have total control of their balance sheet from the point of view of volatility in the balance sheet. But they also have to ensure that they have total control of their reputation in the industry and their ability to service their customers profitably and very, very cleanly compliant. As a state attorney said, if you think that compliance is expensive, have you tried non-compliance? So this is a very interesting challenge.
Yes.
All right. So the banks are recognizing that the cost, not only monetary, of non-compliance is substantially higher than the cost of compliance. But the challenge of compliance is fairly substantial because I've got to be able to demonstrate in an evolving world, both regulatory and structural, that I retain that level of control. And I've got to be able to demonstrate that level of control from an operational perspective, from a financial perspective, and from a regulatory perspective. We recognize that organizations need to be agile enough to participate in that community, but also have enough automation and control to be able to embrace it and service it profitably within a controlled fashion. And this is something that we realize we're doing, and this is what Aurora has been released specifically to provide that. It gives organizations the ability and the agility to embrace new market behaviors with the control and the discipline that ensures that when you do embark on new business initiatives, you are not doing it to the detriment of, fundamentally, your balance sheet.
My second last question. Although rates have started to pick up in the States, other regions still running or experiencing sort of the loose monetary conditions. Margins have been under pressure, impacting banks to manage their cash flows effectively. What are some of the key challenges that your corporate banking clients face on the cash business side?
Control, the optimization of how they manage their end-of-day positions. Because ultimately, if you've got money sat on an Nostro account overnight, it's efficient. So it's making sure that you truly have an understanding of your cost of doing nothing, because fundamentally that's exactly what it was. It was less of an issue when you had very, very low interest rates. Now as interest rates become an issue, then the cost of doing nothing is actually a genuine cost. All right? So some people saw it as being a cost of doing business. Now increasingly it's a substantial cost. So really we're finding that organizations want to have an improved level of understanding of their intraday cash positions, the cash utilization, from a bank's perspective, an understanding of what the cash demands of their customers are and how do I service those, what the cash behavior, so the liquidity demands and the behavior in terms of my relationship with servicing my customers. So we from the cash and liquidity perspective, we've released and we're releasing a solution that addresses the intraday liquidity requirements and the stress testing requirements of an increasingly broad set of users and clients.